Following on from the last episode where we had a glimpse at the significant improvement that could be achieved in backtest with the use of a time of day filter, today I take you through the analysis and the implementation that led to that improvement. Back after this brief message. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. As a trader, you'll benefit from cost-effective market access via multiple trading platforms and APIs. These enable trading and investing in any US stock, over 60 of the most liquid futures contracts, FX and CFDs. You can even diversify your portfolio by buying and selling other traders' strategies as investable assets themselves. So, if all of that sounds interesting, learn more by clicking on the link top right now or find further links in the description right below. Now back to today's tutorial. Time of day filters require analysis of how the specific strategy reacts to the changes in price action throughout the day. Today, I take you through the process that I use. For anyone that is joining me for the first time, this is an episode within the Spotlight on Indicators series, and you can find a link in the video description that will take you to all previous episodes. So, in the last episode, I explained how the use of a time of day filter, when implemented properly, can significantly increase the performance of trading strategies. Now, the strategy that I performed this analysis on was the Stochastic RSI overbought oversold strategy. And once again, if you're just joining us for the first time, then you can find out more about that in those previous episodes. So, as a recap, using nothing other than the overbought oversold signal, we produced the yellow equity curve that you see here. But then with a simple time of day filter implemented, the red equity curve was achieved. And so in today's episode, I'm going to take you through the required analysis in order to inform this time of day filter and show that in action. So first of all, let me explain where I get all of my data for the analysis of a trading strategy's performance. And note that I do this both in backtesting and also in my live trading accounts. And I obtain that data by saving it from the expert advisor into a CSV file, which can then be opened up into any spreadsheet application. Now, this can be an absolute goldmine of information to enable you to analyze your strategies and then, of course, to implement improvements. And I find this a far superior way of performing analysis than simply using the built-in MT5 strategy tester charts. And of course, the additional advantage is that you also have access to this information from your live trading accounts. So the piece of data that I'm interested in right now is this one, the open hour of day. And so this tells me the exact hour that a new position was opened. And you'll notice that a lot of these numbers are whole numbers, and that's because those trades have opened when a new H1 bar has appeared. And typically when you get a new bar in the trading time frame appearing, that often causes indicators to jump, which very often triggers the position open. But also there are some real values, such as this one here, where the value is 1.15, and the 1.5 here doesn't mean 15 minutes. It means 0.15 of an hour, which is approximately 9 minutes. So this is 9 minutes past 1 in the morning. This value here, 1.63, is approximately 1:38 in the morning. And obviously these values range between 0 and 24. Now remember, this is the time of day that the trade opened, and that's what we're concerned about at the moment because of this time of day filter. In future episodes, we will actually look at close times and how long trades are open for also. But to analyze this data, the easiest way is to simply create a pivot table. And so in my row column here of the pivot table, I'm going to choose the open hour of day. And then in the values section, I'm going to choose what I call the normalized net profit. Now, this value is normalized for the position size so that all trades have an equal weighting regardless of how large their position size is. Now, in our case, because we're just using minimum lots, this doesn't really matter because every trade is being opened with 0.01 lots. But if we were using a position sizing strategy that scaled position size, for example, as equity grew, or changed the position size based on the anticipated risk of the trade, then that's where the normalized net profit really comes in for this type of analysis. But for us at the moment, we could equally use net profit and the results would be exactly the same. So we get a list now of all of the hours of day ordered, as you can see, and the normalized profit that would have been achieved from those trades if we'd implemented one full lot as the position size, and that of course is the basis of the normalization. Now, if I draw a chart here, this is going to be relatively meaningless. And there's not a great deal of useful insights that we can get from this. And so what we need to do is to group our time values so that we can see them hour by hour. And to do that in Excel, you simply right click on the column here, say group, and then we'll just accept the defaults here. And now we can start to see something of interest. So here, all of the trades that were opened between the hours of 1 and 2 in the morning are encompassed in this bar here. And so we can see overall, if you add up all of the profits and all of the losses of those trades, the net profit is just over 20,000 for those normalized position sizes. Likewise, this bar represents all of the trades that were opened between the hours of 2 and 3. So effectively, this clump of profitable trades that we see here were all opened in the Asian session up until the point that the European markets opened. The European markets opened at this point, the US markets about here, and then the values at the end here are those out of hours in between the US market closing and the Asian markets opening again. So this tells us something really interesting. All of the trades that were opened in the Asian session seem to be much more profitable on average than any that are opened in the European, the US, or the out-of-hours sessions. Now, in terms of the statistical significance of this information we're looking at, let's just have a look at how many trades are opened in each of these hours. And so to change that, we can simply say that we're interested in the count instead of the sum. And so something that adds weight to this is that in that Asian session, typically there are more trades than there are in the European and the US sessions. And then the total number here, which we've seen in previous episodes, is just over 30,000, nearly 31,000 trades. So just returning now to the sum of the normalized profits, I'm going to make a hypothesis here. And the hypothesis is based on what we saw in the previous episode, where often when a new session begins, price often reverses. Now, with an oversold, overbought strategy, that of course is what we are relying on. We're opening up a position and hoping that the direction of the price will change in our favour. And so what I think is happening here is that the trades that were opening in the Asian session then turn into profitable trades when that European session opens, because that causes that very often dramatic reverse in prices that we looked at last time. And so these trades that are opened at this time go into profit during the European session. Now, I think that the reason on the whole we have a negative profit at the end here towards the end of the US session and that out of hours session is that we don't see that reversal in price very often here. At this point, prices just tend to meander and often go in the same direction that they went in from the previous US session, which is why typically these are showing a loss. And so this, I think, gives us the information to try out our time of day filter. And in that, I'm only going to allow trades to open in the Asian session. Of course, I'll allow those trades to continue to be open into the European and the US session if necessary, and I won't be imposing any close constraints on them, but they'll only be allowed to open in that Asian session. So I've now implemented that filter in my input parameters, and let's start the backtest off. Now, there's two things here that I've spoken about, but I haven't gone into in a lot of detail. And that is the writing of the closed trades file that we saw me perform the analysis on, and then also the code to actually stop those trades from opening if they're not in the Asian session. Now, from a technical perspective, both of those things are actually quite easy to do. And so I'm sure there's lots of you that will be able to implement those without any issue at all. However, if you think that you need some assistance with that, please place a comment on the video regarding whether you'd like to see the code to create that CSV file or to implement that time of day filter. And if there are enough of you that want to see that, then I'll add a couple of episodes onto the end where I'll take you through that step by step. Okay, so I'm going to come back to this in a moment once the backtest has completed. Okay, so that backtest is now complete, and that's the red equity curve that we see here. So as we discussed last time, it's a significant improvement, but let's take a look at what's happened to the number of trades. So previously, if you remember, we had 31,000 trades, and now we have 17,000. And that's because we're not opening those trades that are in the European and US sessions. Now, in the next episode, I'll be doing the same for the standard RSI strategy and looking at how those results compare. And because this strategy has exactly the same premise, hopefully we'll see similar analysis results and a similar change in the equity curve. And then in episode 32, I'll be showing a new technique that's very closely related to what we've seen here with the time of day filter, but this is something that I call time of day equity flow. And again, if implemented correctly, this is something that should hopefully give us an improved backtest. That's it for this episode, but before you go, if you're not already, then please do subscribe to the channel, and by making sure you also click on the notification bell will mean that you get notified when new episodes from Darwinex are released. Now, until next time, trade safe.